Hey everyone, welcome back to Corporate Decoder, the place where we try to decipher what corporations are really up to. Today, we're diving into the latest annual report from Shutterstock, the stock photo giant. And let me tell you, this report has a plot twist worthy of a Hollywood screenplay. Stick around until the end, things are about to get interesting. Shutterstock, a name synonymous with stock images, is looking to tie the knot with Getty Images, another major player in the visual content world. This isn't your typical love story, though. There are regulatory hurdles, stockholder approvals, and enough financial maneuvering to make your head spin. Let's decode what this all means. First, let's get a feel for the business. Shutterstock is a creative platform connecting businesses with high-quality images, videos, and music. They make money by licensing content to customers and compensating the artists who contribute. They are also working in things like metadata, advertising, and distribution. Shutterstock's business breaks down into two main parts: the content offering and the data, distribution, and services offering. The content part, which is all images, videos, and music, made about $760 million, and the data, distribution, and services offerings brought in $175 million. So you see how they still rely greatly on their core business model. Now about that marriage with Getty Images. It's not a done deal yet. They need approvals from regulators and stockholders. The idea is that for each share of Shutterstock, stockholders get $9.50 in cash and 9.17 shares of Getty Images stock. However, some might only be able to get cash or stock and not the mix. It will all depend on the amount of shareholders vote for each option. If this deal falls apart, Shutterstock might have to pay a termination fee. Whether the deal goes through or not, this whole process is costing Shutterstock a pretty penny in fees for lawyers and advisors. This merger talk is also causing some uncertainty among Shutterstock's customers and employees. Some customers might jump ship because they're not sure what the future holds. Key employees might leave for the same reason. It's very common in this type of scenario. During all this uncertainty with the merger, Shutterstock will be limited on what they can and cannot do with contractual restrictions. They have to generally run business as usual, which can hurt pursuing new opportunities. Shutterstock is facing a lot of competition with low barriers to entry. They are competing with other stock content marketplaces, visual content companies, music providers, and even free image websites. This is why it is very important for them to be able to innovate to succeed. Like all these online marketplaces, Shutterstock invests a lot in marketing. If their marketing strategies don't work, it could really hurt their bottom line. It is also important to note that much of their traffic comes from search engines like Google. It would be damaging to their business if search engines change the algorithms, ranking them lower, because it would limit people from finding their website. To have any chance of succeeding, Shutterstock needs to be able to keep and bring in talented employees. But that is easier said than done because competition for technical staff is intense. Also, as they grow globally, they may have a hard time keeping up with the corporate culture. Running a digital business means relying heavily on tech. Any failure in their systems could damage their reputation and hurt their business. Shutterstock faces risks from the content on its platform. They could face claims of copyright infringement. The laws and regulations around content, privacy, and data are constantly changing, creating even more of a compliance burden. Because of the nature of their business, Shutterstock needs to collect a lot of personal information from all over the world. It would be a big problem if the company has a cyber attack compromising data. New privacy regulations like GDPR in Europe and CCPA in California add even more complexity. Also remember that some countries are starting to make them store the information locally. The financial results can swing quite a bit, making it difficult to predict how the stock price will react. Because the transaction will include Getty Images stock, there is no assurance that the stock will be worth what it is at the moment of the merger. One major shareholder, Jonathan Oringer, controls a big chunk of Shutterstock stock, which gives him great control over the company. And with all these factors, like everything with these SEC reports, there is also no assurance that the company can report their financial statements accurately. In 2024, Shutterstock was busy acquiring companies, including Backgrid, a celebrity content provider, and Envato, which offers digital creative assets and templates. The addition of Envato has increased Shutterstock's content revenue from video, audio, graphics, fonts, and templates, and complemented Shutterstock's existing offering with Envato Elements, a leading unlimited multi-asset subscription offering. Shutterstock has a diverse customer base, serving over 4 million customers across various industries in more than 150 countries. No customer represents more than 20% of revenue. On the revenue front, Shutterstock brought in about $935 million, which is up 7% from the previous year. But the interesting part is the difference between the segments. Data, distribution, and services growing at 28%, and the content offering slowing down. This all means that the company might see revenue to the range that they are looking for. Their financial condition may be different than what they are looking for in the near future. Having operations abroad also means that they have foreign currency risks. The trading price of their common stock can also be really volatile. There is always the possibility of unexpected and negative consequences. There is no guarantee that common stock will maintain its price. It is important to also know that the stock price of the company is volatile and can cause great fluctuations in the market. Speaking of volatility, and back to the merger with Getty Images, because the value is tied to Getty's stock, there is no assurance to how much the stock will be worth when the time comes for stockholders to receive. And there is always the constant risk, as with any company, that they will not be able to effectively manage their growth, which could have a material adverse effect. Continuously improving their operations as a public company will mean the company will continue to incur and expect to continue to incur increased costs and face increased demands. Okay, so what's our final take on Shutterstock? On the plus side, their move into data and services is smart and shows promise of growth. But the real story is how they have to rely on new avenues of revenue instead of their core business, which shows a worrying tale. The reliance on this new merger could be all they have left to continue. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, subscribe, and let us know in the comments what company we should decode next.